Vukile Property Fund reported a 5% increase in normalised interim distribution. The company's portfolio changed dramatically over the past year with multiple acquisitions and sales. Net profit available for distribution rose by 28% to 354 million rand. This is accredited to a strong performance by the group's underlying property portfolio. Joining me now to dissect these earnings is Lawrence Rapp, the CEO of Vukile. Lawrence, thank you so much for making the time to join us. Now, of course, 28% rise in the group's net profit, that's an impressive number. Again, would you say that this is largely due to how you've changed the portfolio in the last 12 months?
Sure. Remember, the key number we're looking at is growth in distribution. So that growth in net profit was driven by the acquisitions that we made during the period. So perhaps distorts the picture somewhat. Obviously, the number of new shares issued over that same period. But certainly the overall portfolio, we believe, is now in a much healthier position. We've done a lot of work to improve the quality of the portfolio and reduce the risk. And as you said, driven by a number of acquisitions and then the sales. But one of the highlights of the results for us was certainly the like-for-like growth in net property revenue. In other words, looking at the portfolio that was there last period and this period, that grew by a very credible 8.1%. That was buoyed by the acquisitions and then drawn back a bit by the sales of higher risk properties which were affected during the year.
Let's look at one of the more, if I'd say notable, just in the sense that they've attracted lots of media attention. One of your biggest empowerment transactions that have come across in the media and said as to be the most significant transaction. Let's talk about your now great exposure to sovereign tenant portfolios and what you expect from that portfolio moving forward.
Great. So that was really part of our empowerment deal, where what we did is we bought a portfolio of 4 properties with an option over a 5th from Encha. Encha converted their net equity in that portfolio of approximately 490 million into shares in Vukile. So post the exercise of the option over that 5th property, Encha will hold approximately 6% in Vukile. They will then continue to manage those assets on an asset management and a property management basis, which means that we've been able to retain the skills in understanding how to operate in the government sector from Encha, who've been in that business for well over 10 years. What's also very important about the deal is we have a rather innovative equity funding platform, which means that we've been able to gear up, or we will be able to gear up the Encha stake over time, which means that as the company grows, in fact, Vukile's empowerment credentials will grow, as opposed to normally decreasing as the company grows and issues more equity. But we feel that through the structure of the deal, there is a complete alignment of interest between not only Encha and Vukile, but Encha, Vukile, and all the other Vukile shareholders in the market. So it really is, in our view, a very exciting transaction. It places Vukile as one of the largest empowered funds in the market and certainly able to compete for government leases going forward, should we wish to do so.
Of course, perhaps one of the heavier contributions to your portfolio is your retail segment.
Sure.
How has that performed and how is that reflected in the performance that we are speaking about today?
Sure. Our retail assets have performed exceptionally well. It makes up 52% of the portfolio. Our retail, with the exception of East Rand Mall, is really largely focused on the lower income consumer, trying to locate them at transport nodes. So shopping centres such as Dobsonville, Daveyton, Phoenix, Durban Workshop, we've recently acquired one in Hammersdale. These assets are all performing exceptionally well. What you find is that you have very high trading densities, very high footfall. Most of these assets have over 1 million people a month walking through them. So that's been very good. I think if you look at our reversions on retail, sitting at around 6.9%, still indicative of the strong demand we have from our tenants to stay in the centres and grow their rentals. And then new leases in retail relative to budget coming in almost 10% above budget. Also indicative of the fact that our centres are very well positioned, good quality centres, and attracting more and more national tenants to the portfolio.
Let's look at perhaps the outlier that you've pointed out. This is Randburg, understanding, of course, that there's been a relaunch there. What are your expectations from a revenue point of view?
Absolutely. Remnick Square has been a real fantastic turnaround for us. It was a centre that was really old, a bit run down, had around 64% of the tenant mix being national tenants. We took a very bold call a few years ago to invest heavily in a revamp of that centre. We've spent 207 million rand on doing that. And certainly while it's early days, the initial indications are very positive. So we've introduced a further 23 national tenants into the tenant mix overall. Footfall has increased from around 600,000 a month to 800,000 a month, pre and post the revamp. And for shoppers, it's just a completely different experience. It's light, it's bright, it's airy. It's generally the newest generation stores from all the major retailers, and we can only encourage shoppers to go there, see for themselves and experience what a turnaround that's been. In time, that should then translate into better trading densities, better rental increase opportunities for us, but that will only start coming through at the next rental reversion cycle in that centre. But certainly we're very positive about the initial indications and what we're seeing there.
I've got about a minute left, and I want us to look at the next 6 months. I mean, the last 12 months have been lots of activities. Should we expect any acquisitions, or are you letting go of any properties in the next 6 months?
Sure, we do have an acquisition pipeline coming through. We have a new shopping centre in Letlebile. We have an industrial property in Linbro Park, potentially the Momentum property, which is part of the Encha deal. We would expect to see full year earnings growth of between 4% and 6%, very similar to what we've seen in the first half. However, for 2015, we expect to see significantly higher growth in distribution, as you'll see the full impact of the acquisitions coming through for a full 12 months, and also the base effects of the sales now being out of the system. So to summarize, around 4 to 6% growth for 2014, and 2015 a much healthier growth picture.